Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts and Komal of finance.com and Senthil Manikandan of Newberry Capital join me on the show. Thank you to both of our guests for joining me on the show. Today on Hot Money, we'll discuss the mid-cap IT sector. We've seen a little bit of correction that's come in. The large-cap IT has managed to rebound. Is it time for the mid-cap IT stocks to move up? Manappuram Finance has corrected significantly from the highs of the day of the past few weeks, but is it time to accumulate? We'll ask about what's plaguing RBL Bank at this point of time. That seems to be under trouble. And finally, should Piramal Enterprises be accumulated? It's up almost 4% in trade today. Will the rally continue, or are you concerned about the developer loans that it has and a potential default by any of the developers? But before we start the show, let's see how the recent correction has taken a toll on most blue chip companies in India. Nearly 3/4 of the stocks in Nifty are currently trading below their long-term average valuation. Samit Sarkar is standing by to tell us how deep and broad the discounts are. Samit, on to you.
If you see 37 stocks, that is nearly 75% of the Nifty 50 index, is currently trading at a discount to their 5-year average valuation. Now, this is the highest in at least the last 10 years. And the closest number to this was in 2016, when nearly 69% of the Nifty 50 index was trading at a discount to its 5-year average valuation. And currently in 2018, nearly 75% of the stocks in the Nifty 50 index are trading at a discount to their 5-year average valuation. Now, this fall in valuation also prompted HSBC to upgrade India's rating by one notch to neutral, but they still remain cautious on the Indian markets because according to them, the reasons that led to this fall in the valuations still persist in the market. In fact, Ajay Srivastava of Dimensions Consulting also advises investors to stay away from value investing despite cheaper valuations. Now let's look at the top 10 stocks that are at most discount to their 5-year average valuations and the reasons behind them. Now Tata Motors tops the list as it is trading at a discount of nearly 83% to its 5-year average valuations. Now the reason behind this is the declining sales volume in JLR, especially in China. Then comes the trade wars and the volatility in the US dollars against the sterling pound that have impacted the stock valuations. Second in the list is ONGC, which is trading at a discount of nearly 56%, and that is because of the uncertainty in the government policies. This is followed by Eicher Motors, which is trading at a discount of nearly 54% to its 5-year average valuation, and that is because of an expected slowdown in the Royal Enfield sales and because of the recent plant shutdown issues that the company had seen. Now, Grasim Industries is trading at a discount of more than 50% to its 5-year average valuation. Now, if you see the standalone business of Grasim, there is no concern as such for that, but the company holds a stake in various Aditya Birla Group companies which are not performing that well and might need some fund infusion going forward, and that is the reason why investors are not ready to give a high valuation for Grasim Industries. For Coal India, the stock is trading at a nearly 46% discount to a 5-year average valuation, and that is because of a stake sale at a large discount by its promoter, that is the government of India, and a slowdown in its volume growth that have impacted the valuations of Coal India. Now, if you see Indian Oil Corporation and HPCL, they are trading at a discount of nearly 45 to 46% to their 5-year average valuation, and that is because again because of government uncertainty in government policies, and that's the reason why these two stocks are trading at a steep discount to their 5-year average valuation. Sun Pharma, that is trading at a discount of nearly 44% to its 5-year average valuation, and that is because of a delay in realizing the merger benefits of Ranbaxy because of pricing pressure in its key market, that is US, and because of pending issues related to the Halol plant that have weighed on the stock valuations. This is followed by Indiabulls Housing Finance, which is trading at a discount of nearly 42%. Now for Indiabulls Housing Finance and Yes Bank, we have considered price to book ratio, and the reason behind why Indiabulls is trading at a 42% discount to its 5-year average valuation is because the recent liquidity crisis which triggered the sell-off when it comes to the NBFC space, and that is the reason why that is trading at a discount of nearly 42%. Now Yes Bank, now that is trading at a discount of 52% to its 5-year average valuation. Now this is led by 3 different reasons. The first, it was triggered as RBI denied reappointment of Rana Kapoor as the MD and CEO of the company, and this was followed by a resignation of 3 board members of Yes Bank, and also because of a recent rating downgrades that was done by Moody's.
Okay, so that was how the Nifty stocks have panned out in terms of valuation. But we'll start with hot money. The first sector, in fact, which we want to discuss is the mid-cap IT sector. IT sector as a whole took a beating over the past few weeks, given the fact that how the rupee has panned out in trade. Rupee now almost, in fact, below the 70 level against the dollar. What's the view for most of the large cap IT did manage to rebound, but is it is the trend going to be same for mid cap IT, or should you avoid? That's something that we'll ask again. So Senthil, I'll start with you. Firstly, before we talk about stocks, what's your view on overall IT space and especially the mid cap IT space?
So, particularly if you look at the results during the Q2, I think it was a mixed set of numbers, especially in the mid cap sector, because if you see the players like Mindtree, which has been performing well for the last 3-4 quarters, but their Q2 revenue growth in terms of dollar came below the expectations. They posted around 2% USD revenue growth. But the valuations were not factoring this kind of growth. They are factoring at around 4-5% kind of quarter-over-quarter revenue growth. That's the reason like Mindtree stocks declined when the results came. On the other hand, if you see NIIT Tech, they posted a good set of numbers. Quarter-on-quarter USD revenue growth of around 5.8% and around 30% increase in the order book also. I think market is valuing mostly or looking mostly into the dollar revenue growth of these companies, how their verticals are performing. So I would say that I would mostly prefer companies which are posting revenue growth, because now I think the dollar price depreciation, I think that is also going, INR depreciation is going away from the game, so the margins will be somewhat pressured. So I will go with companies that are posting steady revenue growth going forward, and so NIIT Tech could be one stock I could be preferring, and the valuations also, it's like trading at 14 times 1 year forward earnings, also looks at a fair value, I could say. And coming on to the other stock which we track is Persistent Systems, which has not done so well in the last 1.5 years or so. But if you see the valuations, it's one of the cheapest stocks in the mid-cap IT. Okay,
so we'll discuss these two stocks in detail with you in a while, but let me first get Komal's view on the entire mid-cap IT space. What's your view? Do you think that time is ripe to start accumulating because of the fall that we've seen, or do you foresee more pressure that will come in?
We'll recommend you to, be a approach for a selective buying in a mid-cap IT stocks. If you look, last from October 1st, we have seen a sharp correction in IT sector. The advantage that they were having, from rupee depreciation is now going away. So the headwind, tailwind which was there now is becoming headwind for them. So we are, we'll advise the customers to go for a selective approach. We'll recommend stocks like Mindtree and L&T Infotech to the customers, which has seen a consistent growth. Mid-cap companies, mid-cap IT companies have, much are better in terms of the kind of client they service to. They can opt for smaller projects also, like except large cap companies which have a focus on certain set of clients. So mid cap IT companies has the advantage in terms of looking for a smaller projects as well.
You're saying mid cap IT looks better than large cap IT, is that what you're saying?
Yeah. That is our view, that mid-cap IT looks better than large-cap IT. And here we'll advise a selective approach.
Okay, so selective approaches, which stocks are you all telling your clients to accumulate and why?
Mindtree and L&T Infotech, both the companies have seen a growth in last, if you track their last 5 quarters performance, they are growing quarter on quarter. At the same time, they are, they have a niche, they are niche player in particular segments. So we are recommending those.
So, but Mindtree had a bad second quarter. You saw that the revenue thing, and they are coming off a lower base, and they had the rupee tailwind, as you said. So what's the view ahead for Mindtree? What makes you bullish on Mindtree? What's the X factor that you're looking at in Mindtree?
If you see in last 1 year, the price has increased 60% times as compared to their earnings. But at the same time, the kind of projects they have, at the same time the the quality of the products that they have are much better than the other players in the market.
Okay, and the second one, L&T Tech?
L&T Infotech, again, if you see the last 5 quarters, the quarter on quarter they have performed very well. At the same time, they have delivered the superior numbers. So, and again, the tailwind, the headwind which we see, in terms of rupee appreciation, we see that L&T Infotech has an edge to, bypass that and perform well in coming future.
And valuation wise, how do these two stack up against the peers and large cap?
If you look at Mindtree, it is trading at PE of 20 times and L&T again is trading at 23 times PE. But if you compare it with the large cap players in the same segment, Infosys, let's say you take TCS, which is trading at 23 PE, but growth, from a growth perspective, at the same time, you know, the revenue perspective, this two companies has much higher growth in terms of revenue as well as the number of orders that they are getting.
Okay, Senthil, I'll come to you. The two stocks that you spoke about, one of them was Persistent, secondly NIIT Tech. What's the X factor in NIIT Tech? What makes you bullish?
So we look at the IT in two parts. So one is the traditional service providers, where we are focusing only on the revenue growth side. On the other hand side, we look at the niche IT players like Persistence or even small cap player like Akselya Kale, where these companies are niche focused, like Persistence on the product side, while Akselya Kale is a niche provider to the airline operations. So NIIT, since the management change in the last 1 year, I think all their verticals are performing good, and quarter-on-quarter USD revenue growth of 5.6, and the order book shows good revenue visibility for the next 1.5 years. So on the valuation side, I think also 14 times and debt-free balance sheet, dividend payout for all the IT players looks good. So that's the reason NIIT is
what about Persistent? What makes you bullish on Persistent?
So Persistent, currently we are neutral to positive, not very bullish, because we have to wait over for the next 2 quarters to see how their alliance business with the IBM is performing good, because last 2 quarters alliance business IBM hasn't been performing good. Because of that, I think there has been a decline in the quarter-over-quarter revenue. So Persistent, only reason could be we are having a neutral view is that the valuations are corrected in line with the business fundamentals. So at a valuation of 1 year forward earnings, it trades a price to earnings of 10 times. So for a business that focuses mainly on the IP and IP led and moving, transitioning itself from the traditional IT services to a much more focused on IP lending. So that's the story over there. Okay. So we have to wait on watch for next 2 quarters how the business performs.
Okay, so that's the view that's coming in on the mid-cap IT stocks. The stocks that were discussed in detail include NIIT Tech, there was Persistent Systems, there was L&T Infotech, as well as Mindtree. So these are the stocks that our experts have spoken about today. The next one we want to speak about, and that is RBL Bank. You've seen what's happened with Yes Bank. Yes Bank is down another 7-8%, it's trading below the 150 level mark. But RBL is another bank which has seen selling pressure that's coming in of late. So what's the view with RBL Bank as such? Today it's managed to stay flat, it's recovered from the lows of the day. But we'll ask our guest what seems to be plaguing RBL Bank and what's the view ahead, what are they recommending their clients on RBL Bank. So Komal, I'll start with you. What seems to be impacting RBL Bank? Why is the counter? Is it because of the sentimental impact that the banking sector has, or is there something particular that is worrying investors?
If you see, last few months RBL Bank has been in news because of multiple reasons. One, like Morgan Stanley downgraded their rating. At the same time, after a NBFC debacle, we saw because of the exposure that they have to IL&FS, there was concern in the market because of that. So when you look at RBL Bank, we have a neutral view on that because of so the company has definitely seen a margin growth. If you see, but the margins will be in a pressure, so that will be the upside will be won't be that much. But if you look at the quality of the assets that they have, it is stable and it's in fact improving quarter on quarter.
So overall, as a house, what's your view on the banking space? Are you all telling your clients to go in for private banks? Are you telling them to go in for PSU banks? Are you telling them to go for NBFCs? Because all three have issues of their own and all three have positives of also their own.
From a valuation perspective, definitely yes, the PSU banks are cheaper as compared to private sector banks, but we will prefer private sector banks over PSUs. First, the reason is definitely the quality of their assets. At the same time, the corporate governance issues that they have, and the private sector banks also, we are more bullish on banks which are lending to corporates.
Okay. So which ones are these? Which one are you all recommending to your clients?
So Axis Bank is one stock which customers can look at from a private sector play, which is, and on a PSU, definitely we are not bullish on all PSUs, but State Bank of India is something.
And what on NBFCs are you telling your clients to, because of the concern that's there with, and most of the NBFCs have corrected significantly, are you telling them to be away from NBFCs, or is it the right time to start investing?
Here also we'll ask the customers to go for a selective approach, select companies which has seen a growth year on year. At the same time, their asset qualities are
so
very
which
good.
are these and which are the
So
avoids?
you can look at Bajaj Finance if you are looking for adding NBFCs to your portfolio, and avoid companies which has exposure to real estate sectors.
Like a Piramal or something?
Piramal, yes, we will ask customers to avoid it.
Okay. Senthil, what's your view on RVL Bank firstly before we go on to the other space?
So I think the stock is corrected because of the rich valuations, I could say, because last year it used to trade around 3.5, 3.6 times 1 year forward book, but now it has corrected to around 3 times. But since the takeover of the new management over the last 7-8 years, they have transformed the bank, and I think they are on track to their Vision 2020 goals of posting advances growth between 30 to 35% and steadily increasing the CASA book. So I think the business-wise, the bank has been performing well. Valuation was the main reason, I could say, but even now I think at a 1 year forward price to book of 3 times, the kind of, because most of their assets, if you see, I think only around 27% is retail, remaining nearly 40 to 50% is in the corporate book. But even though their tenure is less than 1 year and they are able to maintain the asset quality, but having a significant portion of corporate book is a concern. But second is on the liability side, if you look at they are building up the CASA, but CASA is still at around 24% versus the large cap private players, which is around 45 to 50%. So they are inching up. So CASA building up and a granular asset book is what we have to watch out for.
Okay, so overall, what's the view? Are there any concerns like what Yes Bank has, or basically I'm talking about the private sector. So how are you telling your clients to play the private sector banks? Because you have your Yes Banks and IndusInd Bank which have corrected because of one on Rana Kapoor and secondly on the IL&FS exposure. But what's your view on the overall private sector bank?
So we prefer small banks in the private sector space. Means DCB Bank or City Union Bank in the space. Because if you look at DCB Bank, their target clients are in line with the NBFCs. So with the NBFCs more focusing on the liquidity side and they are not much focusing on the growth side, I think DCB could be able to garner more growth from these NBFCs, because 40% of their book is towards mortgages, and housing finance companies are firefighting for the liquidity position. So I think DCB Bank would be one, and City Union Bank on the other side, because they are niche focused bank, especially on the SME side, and they have been able to grow their asset book steadily around 13 to 15% over the years, and asset quality also has been stable. And if you look at the track record of the management, I think the current MD has been with the management for a decade or so. So management quality is good, and so having a niche client base is what we are looking into the bank.
Okay, so that's the view that's coming in on RBL Bank and the private banking space. The next one we want to talk about is Manappuram Finance. Again, like the NBFC, some of the gold financing companies have also corrected significantly. It's trading up almost 1.4% in today's trade, but what's the view ahead for Manappuram Finance? Senthil, what about Manappuram Finance? Is it a time to start accumulating?
I don't think so, because still I think the gold loan book contributes majority of their earnings. So if you look at the cycle, I think till FY 11-12 period, I think they were from 08 to 11 or 12, there is a tremendous growth in their gold loan book. But then the RBI regulations came, bringing down the LTV of the gold loans. That resulted in their lessening of competitive intensity versus the banks. So since then, if you look at the gold loan book, growth rate has been in the range of 7-8% over the last 7-8 years, and it will continue to grow so in the range. So, but the management has ventured into other verticals like microfinance, housing finance, and also the commercial vehicle space. But these are newer verticals, and there are also enough well-entrenched players in all these verticals. So it will be tough to garner more clients from this space. So I could remain neutral on the stock.
Is it a similar concern that you share for even Muthoot in the entire gold loan space?
Yes, even Muthoot, because they are larger player compared to the Manappuram, and I could prefer the same, because my main concern could be the growth. On the other side, I think they will be able to maintain their asset quality better compared to other NBFs, because gold is fully secured, and I think Manappuram, their major product is less than 3 months to 5 months kind of period. So there won't be any issues with the asset quality, but growth will be in the range of 7 to 8%. That transforms to the valuations also. I think currently they're trading at around 1.2, 1.3 times 1 year forward book. So that seems fair for a AUM growth of 7 to 8% in the main product vertical.
Okay, Komal, what about Manappuram Finance? What's the view?
We have a neutral view on this. Definitely their AUM has grown by 25%. But if you look at quality, as he rightly mentioned, the quality is very stable. At the same time, during the Kerala floods, we have seen, they even during Kerala floods, where they have majority of their revenue coming from, they were able to maintain the asset qualities. So that works for the company. But at the same and the risk management process that they have in place is very good. They are diversifying into various different states and reducing the exposure to a particular state. That's also working for the company. But yes, as we are seeing issues with NBFCs, and especially as he rightly mentioned, RBI has given some restrictions on the LTV. So these companies will have a pressure on their margins.
Okay, so that's the view that's coming in on Manappuram Finance. And the final stock we want to talk about is Piramal Enterprises. It's been all over the place. From a high of almost 3,500, it went to a low of almost 1,800. Now bouncing back to almost 2,200. But it's not been a good year for Piramal Enterprises, down 22%. And the main reason is the high exposure. It has almost 77% of its loan book is given to real estate. And when bonds of Lodha are falling, and there are concerns about some of the companies defaulting, the entire real estate space seems to be in trouble. Piramal's exposure to real estate seems to be the big concern that the street has. But is that Piramal on its part is saying it's fully covered, and they're getting their money. But what's the view ahead on Piramal? Should it be accumulated? It's a quality name, but what should they do? What about Piramal Enterprises, Komal?
You can accumulate only if you have a very long-term view and you are ready to see the volatility in your portfolio. Otherwise, we will recommend you to avoid that stock, because it's purely for a long term and for a customer who is ready to digest the volatility. As you rightly mentioned, they have a exposure towards Lodha, Omkar Group, and after Lodha's bond the declined sharply, there were concerns regarding the Piramal Enterprises. But if you see their entire revenue, they have a well diversified portfolio where the revenue is also coming from. They are also improving their pharmaceutical business and trying to increase the growth from that particular segment. So from that perspective, only if you are a long-term investor and ready to digest the volatility, customer can look for.
But overall, you see that there could be more potential volatility in the short term, given how the real estate sector is panning out. So Piramal on its part is saying that we are secured, we are retaining our funds. But is that a concern that you have, that there could be some bit of problem at any end?
Definitely, they have as they are saying that it is secured. But if there is a panic in the markets, all of the company will see the pain. So it's not easy for anybody to just leave out of that particular game. So there will be volatility in near short term, and there is a pain in real estate sector which is going to affect them.
Okay, what about you, Senthil?
So like you mentioned, I think 70% of their financial services book is exposed towards real estate.
Just one second, I think Arun Jaitly is speaking. Let's just cut in and hear what he has to say.
At that time, it was welcomed by the people in the then government. In fact, they said that the new GDP series has conclusively established that we did not mismanage the economy. On the 3rd of February 2015, this statement was categorically made by the former finance minister, welcoming the new series. Now, in continuation of the same exercise, applying the same yardstick, the new series has been made applicable from 2004 or 5. So the growth on the basis of the new series may be revised upwards or downwards depending on the applicability of the data. The formula is the same. So when you compare the GDP from 2004-5 till 18, you can't have two different periods with two different yardsticks. The yardstick has to be the same. Now, based on the same yardstick, for the earlier 8 years of UPA, the GDP has been revised downwards. So you gain in some years, you lose in some years. Data is realistic. It is not fictional. And this formula is globally more comparable. So what was welcomed by the UPA in 2015 is now being criticized in the year 2018 because it revises it downwards. The CSO is a highly credible organization. It completely maintains an arm's length distance from the finance ministry. In fact, we also come to know of the data only when it is finally released. All former individuals and very eminent people who headed the CSO are of the same opinion that this data is far more inclusive and far more reflective of the situation of the Indian economy, and therefore has far greater credibility. I don't think any service is being rendered by people who choose to discredit a highly credible organization like the CSO because its data is really based on facts and the revised formulations, which is a continuous exercise because every time you try and improve upon your formulations to make them more representative of the real state of the economy itself. कल CSO ने अपने न्यू जीडीपी सीरीज के बेसिस पे 2004-05 से लेकर 2011-12 तक अपने रिवीजन सार्वजनिक किए हैं.
Okay, so that was the finance minister. Sorry, Senthil, we are running out of time, so we won't be able to take your view on it. But with that, it's a wrap on today's episode of Hot Money. Komal, thank you so much for coming in. Senthil, so much for coming in today. Our speak you comes up next. Stay tuned to Bloomberg Quint.